Hello everyone, here is the answers to the Unit 13 exercises. In exercise 1 we have a discounted note. So we need to record the journal entries for the following events related to XYZ Company's discounted short-term notes payable. On November 1st, they borrowed $36,400 from Northeastern Savings and they signed a 12-month zero interest bearing $40,000 note that will be repaid in full plus any interest if necessary 1 year from its signing. What does this mean? It means that our company XYZ is getting $36,400 now, but in a year from now we have to repay $40,000 to Northeastern Savings for letting us borrow it. So essentially no one's going to let anybody borrow money unless they're making something off of it. What's Northeastern going to make off of us? They're going to make that $3,600 extra. This is our, even though it says a zero interest bearing note, this is the implied interest of this note. So since we're signing it in the middle of a year, we're going to have to accrue some interest at the end of the year, and then we're going to record finally on the following November 1st the payment of the balance of this note plus any interest if necessary. So let's start with the first entry on November 1st when we are signing this note. We're receiving cash, but we're not getting the full $40,000. We're only getting $36,400. Well, that's a conundrum because we're going to have to pay them back $40,000 a year from now, which means we need to credit notes payable for $40,000 to increase that liability. Again, we're getting $3,600 less now than we have to pay back later. Essentially, the company that we're borrowing from, Northeastern Savings, discounted the amount of money they gave us. So the difference between the amount of cash that your company is receiving at the time and the face value you have to repay in the future gets debited to an account called discount on notes payable contra liability account, so it goes up on the debit side. At the end of the year, we have to accrue any interest that would be owed on this note. So on December 31st, we're going to make an adjusting entry to recognize the interest expense. To figure out how much we get to recognize, we got to figure out what portion of time in the note's life has passed. Well, the original discount on this note was $3,600. How much time has passed? We signed on November 1st, so November 1st the month of November and the month of December. 2 months have passed. This note has a 1 year life, so 2/12 of the note's life has passed since we have signed it. Well, if we take $3,600 and multiply it by 2/12 or 1/6 for you, those of you who like to reduce fractions, we're going to get an interest amount of $600. That's how much we get to recognize during the period. So that is our interest expense. We're not actually going to have to pay this interest though, because it's assumed to be in the difference between what we received in cash and the amount we have to repay in the note. So what we do with the credit in this accrual entry is we actually decrease the amount of our discount on notes payable. So we're going to credit discount on notes payable for $600. And then on the following November 1st, we're going to pay the balance of this note plus any interest if necessary to Northeastern Savings. So the following November 1st, we're going to debit notes payable to take it off the books because we're paying it off. How much do we have to pay them? We have to pay them the full $40,000 that we agreed to at the time of the note signing 1 year before. We need to recognize any remaining interest on this. Well, let's do the same thing we did before. Our original discount at the time of signing was $3,600. How much time has passed? How many months do we need to still accrue interest for or put the interest for on our books? We already did 2 on December 31st. So now we need all of the months of January through October, which is 10 months, the remaining 10 months in the note's life. $3,600 times 10/12 means $3,000 of interest needs to be recognized. So we're going to debit interest expense for $3,000, and we're going to credit our discount on notes payable for that same $3,000, taking it off our books. And lastly, we're going to credit cash for how much we actually owe them, which was the full face value of the note, which was $40,000. So in essence, on a discounted short-term note, there are no actual interest payments that go. The interest payment is assumed to be what is I guess, sucked out of the amount of money that you borrow up front. So eventually, over the life of the note, we're going to have to recognize that difference, this $3,600 difference in interest, and we did. But we can't do it at the time that we signed it. Like, you can't just say cash and then notes payable for face and recognize interest of $3,600 because people would manipulate it. It's accounting. You have to actually recognize the interest after a certain amount of time has passed. In exercise 2, we have warranties. In our company, which is Present Smartphones, sold 100,000 phones on account for $500 apiece during the year of 2017. We have a no questions asked replacement policy, which means someone buys the phone, doesn't like the phone, they send it back to us, and it's not a refund policy, it's a replacement policy. So we send them a new phone instead. Maybe something's wrong with the phone that they got, but we'll replace any model that people send in with that same model. We estimate this is going to happen for 2% of all of our phone sales during the period. So we need to record the journal entries for the following things. First, the credit sale for these phones during 2017, and then we also need to record not only the replacement costs that we already paid during the year, but what we expect to have to pay in the future for units sold during 2017. Start with the first entry because it's much easier. Record the journal entry for the sale of phones during 2017. These again are on account, so our debit is going to be to accounts receivable. And we figure out how much to debit by taking the number of units that we sold during the period and multiplying it by the unit sales price. If we sold 100,000 phones and we sold them for $500 a piece, that means we're going to make $50 million owed to us at this point, and we record it under sales revenue. So just like any sale on account entry, it is a debit to accounts receivable and a credit to sales revenue. We recorded our 2017 credit sales. The fun part of this entry is what to do with these warranty costs. So on December 31st during the year, we're going to record a warranty expense, and we have to figure out how much that's going to be, because it's not just the actual amount of warranties we had, but all units sold in 2017 that people are expected to ask for a replacement for. You have to have the expense match the same period as your revenue. So we got to figure out what portion of, this sales that we did, we're going to end up having to pay a warranty expense for. Well, it's not so bad. What we need to do is figure out how many units we think we're going to have to replace. We sold 100,000 phones. We estimate that 2% of those people are going to want to replace with a different phone. Well, 2% of 100,000 means that's going to happen with 2,000 phones. And if each phone has a unit price of $500, well, we multiply that out, and we're going to get an estimated warranty expense for the period of $1 million. However, $200,000 worth of this has already been cashed in. So what are we going to do? Well, we're going to have to go and we're going to have to take that out of our inventory because we're replacing the phone. So the amount of actual expense that we've already paid comes out of inventory for $200,000. And the remaining difference between these two numbers, which is $800,000, is going to go into an account which is our estimated warranty liability. So we're putting on our books at the end of this period, the year 2017, not only the expense that we expect to have for 2017 sales related to these warranties or these replacement policies, but also our estimation of a liability in the future, what we're actually going to have to pay out in the form of inventory. And we recorded our warranty expenses related to 2017 sales. In exercise 3, we have employee benefits. We're going to focus on 2, vacations and bonuses. So we have ABC Company, and ABC Company employs 50 workers who make $600 per week, and each worker earned 1 week of paid vacation during the year of 2020 to be used during the following year, 2021. So we need to put that amount of money owed for vacation pay, paid time off, on our books. We also pay a bonus, and that bonus is each employee, we have 50 employees, gets 0.1% of the company's net income during the period. What we have, that ABC Company had $10 million worth of net income, so we need to put any bonus to be paid out in the future on our books. And then on December 31st, 2021 this time, We're going to actually record all of the payment of our employee vacation during the period, with the catch that our employees all got a raise. So they're making more now than they were at the time when we put our liability for employee vacations to be taken in the future on our books. We'll account for that in a second. And then finally, in our last entry, we're going to pay that year-end bonus from 2020. Step by step, let's start with the first one, where we need to put employee bonus or employee vacations that are earned onto our books. So on December 31st, this is 2020, we're going to debit an account called Vacation Benefits Expense, and that is for the amount of weeks of vacation that were earned by our employees times the average current salary of our employees. For the sake of simple math, everybody's going to make the same in this example. We had 50 workers. Each worker is earning 1 week, so that's 50 weeks earned. And if they're getting paid $600 per week, that means that our company, ABC Company, is going to have to pay out $30,000 for vacation benefits during the next year if everybody takes all of their vacation time. And since we know we're going to have to pay it, we have a liability to put on our books. We're going to call it vacation benefits payable for the same amount. In the next entry, we're going to deal with this employee bonus. Again, December 31st, 2020. This time it's employee bonus expense. I have seen books before where people roll all of these different types up into fringe benefits expense or employee benefit expense. You can if you want to, but I always like to have them separated so I know how much went to what type of perk that our employees are getting. Just gives you better information to work with. So we're going to call this one employee bonus expense. So how do I figure out what the employee bonus is going to be? Well, we know that we had $10 million in net income, and we know that each of our 50 employees is going to get 0.1% of our net income. And I know everybody's first inclination when they're looking at this is going to be say, okay, 50 employees each get 0.1%. That means in total they get 5%. So we just take 5% of 10 million and we get $500,000. That sounds easy enough, but actually it's not. See, the 5% has to be what is left over after they're paid. So after this bonus is paid out, employees get 5% of the money, and the company gets to keep the other 95%. Don't worry too much about the theory of it. What you should know is the calculations. How you figure out how to do this is you take the amount of net income and you multiply it by the total percent of bonus being paid, and then you divide that by 1 plus the percentage of bonus being paid. So if we take 10 million and multiply it by the product of 0.1% and 50, and then divide it by 1 plus the product of 0.1% and 50, we're going to come up with $497,512 rounded to the nearest dollar. That is our employee bonus expense, but we're not actually paying it. So we're going to create a liability called employee bonus payable for the same amount. December 31st, 2021, in our first entry, we're going to record some vacation benefits expense. See, what is happening here is when we put this on the books the year before, when we put our employee vacation benefits on the books, everybody was making $600 per week. Well, now they all have a $50 per week raise. And when you take a vacation, you obviously get paid at your current wage. Like, people will be very unhappy if you earned a vacation week 10 years before when you were making way less money, then you finally go on vacation and they're like, yeah, you can go on vacation, but we're going to pay you what we paid you 10 years ago when you earned it. Like, no one's going to allow that. They have to pay you what you're currently making at the time, which means since they're making more, we need to put more expense on the books. So what are we going to do? We're going to take the amount of raise each employee got, in this case 50, and we're going to multiply it by the number of weeks used. Well, our employees, it tells us in here, used all of the vacation that they earned during 2020. And if we remember from our first entry, we had 50 employees who earned 1 week apiece, which means they used 50 weeks. So 50 weeks times $50 per week is going to be $2,500 extra dollars in vacation benefits expense we have to put on our books because our employees got a raise in this period from the last. We already created a liability for the $600 portion of it, which was $30,000 in our first journal entry. Well, let's take that liability off the books because we're actually paying for benefits. which means we're going to need to credit cash because that's what we're paying out, $32,500. And then lastly, we need to pay our employee bonus. This is pretty much the way you pay off any liability, and we already put the liability on the books. We just debit employee bonus payable for the amount we determine the bonus to be, which is $497,512, and we credit cash for that same amount. In exercise number 4, we have premium inventory. And what premium inventory is it's things that your company buys which we don't directly sell to customers. Instead, we offer them as a reward for people making frequent purchases through our company. So our company in this example is going to be Amazing Bread, and they sold 10 million loaves of bread for $1.50 each during 2017. Amazing Bread is currently running a promotion where customers can send in UPCs from 15 loaves of bread to receive a limited edition action figure. So people that like our bread save 15 barcodes from the bag or whatever the bread comes in and send them in, and they get one of these limited edition action figures. These action figures cost Amazing Bread $5 a piece to buy. They're a bread company. They're not making toys. And they purchased 250,000 of these action figures. When you have a promotion like this, it's not like every single UPC is going to come back in. There's tons of people that are going to go and buy Amazing Bread because they need a loaf of bread and are never going to worry about this action figure because they don't want it. So 100% of sales don't lead to premiums. Only a certain portion is, and you have to make an estimate. Well, Amazing Bread's going to estimate that their portion is 30%. So what we need to do here is we need to record the sale of the 10 million loaves. We'll ignore the COGS entry. We need to record the purchase of these action figures, which we're going to use as our premiums. We need to record the distribution of premium inventory, so actual units sent out, and we need to record any expected liability for units that are still going to have to be sold out related to our 2017 sales. Let's go step by step. In the first one, let's record the sale of bread. Let's just assume these are all in cash because I don't think people are going to take out a receivable for a couple loaves of bread. How do we figure this out? We take our units sold and we multiply it by our unit sales price. We sold 10 million loaves. Each loaf cost $1.50, which means we're getting $15 million in cash from the sale of this bread, and we're going to record it under sales revenue for the same amount. In the next entry, we're going to record the purchase of these action figures, which we're going to use as premiums. And when you buy inventory, buy things to be used as premium, you can't put them in your inventory account because you don't intend to sell them directly to customers. So you're going to make another asset account called premium inventory. And again, all inventory, doesn't matter what type it is always recorded at cost. So what was our cost to buy these action figures that we're going to hand out? Figure how many you purchased, multiply it by your purchase price per figure. We bought 250,000 action figures. Each one cost $5, which means our premium inventory is going to be $1,250,000. And how did we pay for it? Let's just assume it's cash for that same $1,250,000. And we recorded the purchase of premium inventory. And the third entry, we're going to record the actual distribution of 50,000 units of premium inventory. And when we distribute them, we're going to record the expense for it. So this is going to go under premiums expense. How much are we going to record under premiums expense? Well, it's the number of units, action figures, that we distributed during the period times what our unit cost was to buy those in the first place. So we distributed 50,000 units. Each unit cost us $5 a piece to buy, which means we're going to record $250,000 worth of premiums expense. And we're going to take it out of our premium inventory because we no longer have those action figures on hand, so we credit it for the same $250,000 to record the distribution of premium inventory. In the last journal entry on December 31st, we need to record the expected liability for distribution of premium action figures during the upcoming year of 2018 related to 2017 sales. So what I'm saying is we need to figure out, okay, we've distributed this many action figures already. How many do we expect we're going to have to distribute in the future before this promotion runs out? Well, we're going to have to record an expense for this because Again, these sales happen in 2017, and we have to have all expenses related to the sales on our books in 2017. So we need to record the expense for all of our estimated distribution of these figures in the future. How do we do that? Well, we got to figure out a bunch of stuff right here. In this example, we sold 10 million units, which means there's 10 million UPCs out there, but we don't expect all of them to come back to us. We think only 30% of our bulbs sold are going to have their UPCs redeemed, which means we're going to get 3 million of those back in the mail for people that want these action figures. Well, each action figure requires our customers to send in UPCs from 15 loaves of bread, which means those 3 million UPCs that we're going to redeem is going to cause us to have to send out 200,000 premium units in the future. And since each one of those costs us $5 to get, our expected cost of total premiums to be distributed is going to be $1 million. So for our premium expense, we need to take our expected total cost, which was that million, and subtract from it the amount of premiums that were already distributed. And that's going to be 750,000. 1 million minus the 250,000 that we just sent out. And we're going to put that liability on the books for $750,000. And we recorded a liability for estimated premiums.